So anyway, continuing here, so we are looking at markets right now that are extended. And psychologically, they are tough to chase because you don't want to be, and we always hear this, you don't want to be the last fool in the trade. So we always psychologically finding it tough to chase markets. And markets force investors to wait for meaningful pullbacks that never come. Like, you know, the S&P 500, everybody's waiting for this pullback, but it doesn't seem to come for some reason. Also, stocks you sold months ago for a decent profit, or even at times good profit, go on to increase in their run, and you just sit there feeling very stupid, you know, and ultimately it leads to some level of confusion. Now, like I said, we are here, and this is causing problems for all of us and for investors on how to play these markets. So this is the S&P 500 return here. Let me take that back. And we're up 156% since the March 09 lows. Now, at various points throughout this last couple of years, everybody's been expecting a major pullback. You know, maybe we had a pullback on 2011 summer, but that was pretty much it. Since then, it's been slow or shallow pullbacks and the market just grinding to new highs. And recently, we've seen the resurgence of just amazing moves. These are moves that we saw in late 2000 or maybe late 2007. For example, take a look at Tesla here. I mean, since it broke out above $40 in April, and I'm not talking about the lows in last year, I'm talking about the breakout above $40 that you can see there. Stock is up an amazing 365%. Now, that's a major move. At what point do you get into this move? Even if you get 20%, 30% of this move, that's still a decent return. And also the motivation for this webinar is to tackle issues like that. All right, we've seen gold pull back significantly from its all-time highs. And an instrument like this one, and I'm going to take a minute here because the portfolio I show you return, most of those gains came from owning this instrument, and I'll show you exactly what is it I was looking at and what we were looking at when we were playing this instrument here. So it's up 370% since it broke out of the February base there, as you can see. I'm not even talking about the lows from last year. That would make this probably a 450% gainer since lows of last year. So I'm talking about these big moves, not just the shallow moves we see in markets. And now I ask you the question, what would you do? Here's Facebook. After the earnings, we saw the stock explode. So investors are wondering, do we play this stock or not? All right. And I'm not going to be able to answer this right here because the chart, it's forming itself. And maybe if you stick with me and follow me along, even after the webinar, this one is still curing, and I think it's going to give us an opportunity, but that's going to take place down the road when the chart is ready for us to see the signals that I'm going to be talking about in part. All right, I'm also talking about major world market moves. For example, the Japanese market was up from 1983 breakout to new highs to the highs, all-time highs, late in 1998. It was up 375. Now, that's a major move. Now, what we're going to be talking about are ideas that show you how to get back in a stocks move, and yet very simple, even though there are other factors that we always have to consider. And like I said, we can't capture all the lesson in one short webinar. But over time, I'm hoping to be able to show you the things that are important in finding such major winners. Let's take a look at the NASDAQ here. The NASDAQ, since 1995 breakout to new highs, it moved 576% in under 5 years. Now that's amazing. Stuff like that excites me. How can a market move so much in such a short period of time? Now, relative to the S&P 500, where I show the arrow is where we are. 156% from the breakout in 95 to about late 98, that's 156%. So this is where the S&P 500 is trading. I'm not saying it's going to go the same way as the NASDAQ, but I'm just trying to show you that we never know. We don't know how far the market could go. So we have to respect the upside potential and still be aware that there could be downside pullback. But this is the types of moves I'm talking about. Now, I'm not going to say it's simple. even though really, at the end of the day, what I'm going to show you is simple. Intellectually, you already knew that nothing I'm going to show you is simple. And I can assure you, it's not my style to try and promise you any holy grail. All right, here's a fact. We all know, we've seen it time and time again, we see it every day, that there's serious money to be made chasing explosive momentum stocks. That's a fact. We all know that. The thing is, we get scared, especially when we're not sure what we are doing. But that's a fact. We need to learn how to chase this great momentum stock. So don't let your dreams be dreams. I say, let's chase them. All right, drum roll. So now here's the lesson now. Okay, whenever you are chasing a stock on a daily chart, this is what you should look for. Wait for at least 2 days of rest. Now if you use that, just at least 2 days of rest, and by 2 days of rest, I mean the two down days below the highest daily close. I hope that makes sense. So you wait for a stock to make a new daily high, and then wait at least 2 days. It can be more than 2 days, but the minimum is 2 days of rest below that daily closing high. On the weekly chart, it's the same thing. On the weekly chart, you want to wait for at least 2 weeks, 2 weeks of rest. That's the minimum. That's how you can chase them. Now you can chase them. If the stock rests for 1 week and continues above the previous weekly closing high, then you're not entering a fresh trade. You're entering a continuation of the previous move, and the risk for being off your timing is very high. So wait for 2 weeks of rest. On the monthly chart, you only need to wait for 1 month. Let me repeat that. On the monthly, you want 1 down month, and then once the stock moves above the previous monthly closing high, you can get back into the trade. All right, I'm going to caution you here because what I explained over the last 3 slides seemed very simple in nature, but in reality, markets are volatile. Stocks can attempt several times to break out, and sometimes they can fail, and they do fail, and sometimes eventually they can succeed. In fact, it's not uncommon that before a great move, a stock will shake out everybody and then take off. But what I'm trying to say here, let's all relax here a little bit. The method works, but we also have to understand that sometimes the market has to probe a breakout before finally either confirming a breakout or a pullback and a failed breakout. But remember one thing, and this is very important. It's very important. For some reason, the absolute best performing stocks tend just to slice through that breakout level. Why this is the case, I don't know. But great stocks who have the propensity and just the trust to slice through that breakout level. All right, so I'm going to say set it and forget it. What do I mean by that is when you're chasing a stock and you don't want to just go in there and buy, wait for that rest. So on the daily chart, once you see that the stock is off its highs on a daily closing basis, your recent daily closing high is your buy point. So you wait for 2 days of rest, and any time down the road in the future, maybe it's on the 4th day, the 5th day, the 10th day, 2 weeks later, it doesn't matter. Once you set that alert, then you know that's the time to go back in the stock. Also on the weekly chart, the same thing. Your highest weekly closing high is your next buy point. On the monthly chart, it's the same thing. The highest monthly close is your next buy point. All right, remember there are other factors to consider because you have to understand is the stock overbought or over bullish, and that's a huge distinction. All right, you have to have the technical understanding to know whether this is a kind of stock to chase or this is the one you don't want to touch, even though it's extended. So, and like I said, we cannot cover everything in one session. So stay with me, and over time we're going to break this into small pieces so we can understand what we are doing. But just understand that you need to understand that. And that's why I encourage you to follow me along and continue with me as we try and build a picture of what we need to understand when we're chasing extended stocks. So after this slide, we're going to take one example of a stock that was up 7,000% in 2.5 years. Now this doesn't happen all the time. It's probably once in a lifetime. But why I'm using this example is because A, it's from a different time period, and the fact that the gain is also huge gives me my second reason for showing you this example. The fact that it's such a big move makes you understand that stocks can move beyond anybody's wildest dreams. All right, let's go back and take a look at this one good example here. Okay, this is Yahoo's homepage in October of 1997. Now I wonder how many of you ever used Yahoo back in the day. But this is how the website looked like. Isn't that amazing? Okay, so let's go back to 1997, and this is how Yahoo looked like as far as the stock price was concerned. Now I've shown you yellow or green lines. The green lines show you the breakout levels, and I've also indicated the number of weeks that the stock rested before it continued its rally. Now the one thing I would like to mention here is the percentage gain I'm talking about is relative to this breakout at $1.60, which is a split adjusted price. Of course, Yahoo never traded at $1.60. It's a split adjusted price. So what I'm trying to say here is, starting from July of 1997, Yahoo made a new high, and it settled down for 2 weeks, and you can see on the 4th week it broke out to new highs. It never looked back. That's what I'm talking about. And then again, it had 2 weeks of rest and took off. And this was probably good for about, let's call it about a 100% gain. By the time it was 100% gain by the time it settled here in September. So even at that time it was extended, but you see on this chart, by December, the stock was breaking out again. Okay, now remember, this is split adjusted. Now I want you to just follow me here, and we go to the same stock. 6 months later, the stock is not trading at 360. It's now broken out again in March of 2000. By the way, this is a weekly chart. I forgot to mention, we are looking at a weekly chart. In March of 98, it broke out again. Okay, and then again, it went up 1, 2, 3, 4, 5, 6, 7, 8, 9 straight weeks with 1 week of rest, and then it would settle down for about 8 weeks. And July of 98, you see the stock breaking out above 750. Remember, we are buying it higher and hoping to sell it higher. We're not looking for buy low, sell high strategy here. We want to buy them when they're breaking out and sell them at a higher price when they're really extended and moving higher. So even at this price, this is a stock that broke out July of 97, and now in July of 98, the stock is at $10. Now, why would anybody want to buy the stock there? Well, let's follow along. You see now, by the end of the year, 98, the stock was trading at 35, a high of 35. That's amazing. So think about it, from $1.60 and now at 35. This is the kind of move I'm talking about. But if you take a look at the lines that I draw here, the green lines, I'm showing you exactly where the stock would settle down for a couple of weeks and move again, settle down for a couple of weeks and move again. You can see that in October of 98, there was 1, 2, 3 weeks of rest, and then on the 4th week, it broke out to new highs. That would be at about $16 breakout. Okay, and there was another breakout after 2 weeks of rest, actually 3 weeks of rest, again late November of 98. Let's take a look at Yahoo in 1999. Now you see the stock had gone as high as $60. Now who would want to own a stock like that? But what you do in this particular example is take a look at this chart. If somebody presented you a chart like this and said, hey, I think we need to buy Yahoo, what you can do at the time is you notice the closing high of about $52. $52, which is the weekly closing high at the beginning of April of 98. Oh, actually of 99, sorry, 99. So once the stock breaks out, you set an alert for $52 roughly, and you buy it if it ever breaks out. Again, even though this is a very extended move, we're talking about 3,000% gain at this level, maybe even more than that by then. So you notice that if you use that strategy, you would have been into Yahoo's trade sometime in October, November period there, when the stock broke out above $52. That's all you had to do. Wait for that weekly breakout to take place. Now let me hurry here. And then now you'll see that even after that, Yahoo would still go on to trade as high as at $120. Remember, $1.60 all the way to $120 and change. So in this particular example, I just wanted to show you that that's how it looked like on the weekly. I want to quickly look at the monthly chart. Now this is the monthly for Yahoo. Now you see that the arrows I show you here is the buy point. You see there's 1 month of rest in October of 97, and then Yahoo breaks out. There was 1 month of rest, January of 98, and then another breakout. There was 1 month of rest in about May of 98, and another breakout. 1 month of rest here in about August of 98, and another breakout. This is what I'm talking about, at least 1 month of rest. And you see there was another major breakout in October, November of 1999. Now that breakout you can see was above a buy point of about $45. So that would have got you in Yahoo at $45, and you would have sold it higher. That's all I can say. All right, now let's take a look at gold here. We know gold has been down over the last couple of months. Okay, this is what I want to show you quickly because I can see here we are running out of time. Okay, gold had settled the DUST, which is 3 times short the gold trade. Now this is a trade that we played this trade very well. Our entry point was at about 35, maybe even less than that, because we had seen something on the weekly chart. But once gold or the DUST had a nice move in February of this year. Yes, go ahead.
Could we just clarify, when you say that we did the trade, you mean that this is something that's in your portfolio for the educational trader, and once that portfolio goes live on MarketFi, then those are the same kinds of trades that will be available to people who subscribe. Is that correct?
Yes, Nathan. Now, you know, I at this particular point here, I had not started my trades on MarketFi, but I'll show you in the next slide where those trades are shown on the MarketFi portfolio right now. Because I really do wish, because this is one that I was you know, talking about and talking to my subscribers on on the Muathe.com website. But so the trade was there, and you know, but not on the current portfolio right now. The next slide I'll show you where we got in on the portfolio.
Got it. But these are the kinds of trades and the same style and the same kind of thing that people can expect from the educational trader. Is that right?
Absolutely.
Okay. Just wanted to clear that up.
All right. So we can see here quickly, you can see DUST settles down for 1 month. We had our buy point at 55.35. So the next month, you see at some point the next month the stock broke out above 55.35 and was up 125% since that breakout. Now that's what I'm talking about. 1 month of rest is all I'm talking about. So you see the same month the stock pulled back and closed at 82.29. Now this is where I start trading with MarketFi around June, and this is the trade that I put on because I looked and I knew that the buy point was 82.29, and the following month, after that 1 month of rest, stock breaks out, and you can see this is now about a week into June, and that's the trade 2 weeks later. Stock was up 100%. All you had to do was wait for that 1 month of rest, and this is a trade that pretty much shows up on the current portfolio that you're looking at here on MarketFi, and the portfolio I'd like you to be tracking. All right, because I don't want to keep you guys all evening, I would rather, here's what Elon Musk says, I would either watch it happen, I could either watch it happen or be part of it. And I think that's an important and a good statement here, because we can either watch these stocks from the sidelines or we can be part of their moves. And I would like to guide you through these moves. So here's Tesla's move. Now, ever since Tesla broke out at about $40 or so, you can see the stock is up 365. But on this chart here, which is the weekly chart, you can see that in June of this year, Tesla had two weeks of rest. So if you use my method here, even though the stock was scary to own at the time. If you had used my method, you had 2 weeks of rest, and on the 4th week, the stock broke out, or at about $100 and let's say $5, $103. So you would have got in there, and there was another entry point recently at about $130 when it rested towards the early part of July. 2 weeks of rest, and then it broke out again. All right, so let's take a look at Tesla from a daily chart, and we see that now on a daily, I want to show you where you had multiple entry points if you use the same method here. We have 7 days of rest in April and an entry point which was successful, 2 days of rest in early May, and then you had a failed breakout. I have to note that there was a failed breakout here sometime in the middle of May, and then another breakout in May again after 4 days of rest, 21 days breakout in July, and then 9 days of rest, and recently 2 days of rest. So Tesla did give you multiple entry points, and that's what I'm saying is, by understanding, remember we're not looking at other factors which we can discuss on another day, but just looking at the day-to-day entry points, this is how many times you had opportunity of trading this monster mover in the market.